Hi, this is Paul from globaltradingsoftware.com, and continuing the theme of range breakouts this week, I'm on oil now, and this is the straddle trade with oil. So we're going to be using the range breakout. We look at the oil pit open the first 5 minutes. Now, the straddle criteria is that the range breakout bias that the software produces is neutral, so it's yellow. That has to happen first. Then from the bias depth heat map here down below, we have to be, the neutral has to be the predominant color within those 6 different time frames, or equal to the rest. So in this case, we have 4 yellow, 2 green. We're good for the straddle. The straddle means you put a short order on 2 ticks below the opening range, and you put a long order 2 ticks above. The rules for entry here is the signal has to be taken, the entry has to be taken, the limit order, within the first 3 candles after that opening range. This happened at this point here. The next point here is that the manager cloud is already green when we get that opening candle. So we use what's called a confirmation trade management strategy. So we're basically using this cloud as our target, if you like, for when we get out this trade. So when the cloud turns red, we get out. So we get the signal. This time on the oil opening range, it is a neutral bias, so it could go either way. To confirm that, we make sure the bias depth heat map is predominantly yellow. There's more yellow than anything else. Then we put the long order on, the short order on. When the long gets taken in this case, within the first 3 candles, the short order becomes the stop. We then move, let the trade run through. It pulls back. Now the manager's telling you this pullback is lower than average volume because these dots are below the candles. Pulls back up again, we pull back down again, and all the time this is now green. So where did we move? What sort of move was this? This was, let's just measure that again, $250 tick move, $2,500 tick move, and we're still in. There's some trade management cues that you can take here. After this pullback, we need to ensure that we understand we have a range here. Okay, so let's just put that in light blue. When we have this pullback and we break this pivot here, we can adjust the stop just underneath here to lock in some profit. We then have another slight pullback or a range bound period, and it breaks that again, so we can adjust the stop up to this pivot here. Now we are in a situation where we're going sideways. The volume is not really dropping off. You know, we've got lower than average volume here. We did have a higher than average volume down candle, but it was a 1 candle wonder, so we're not actually doing anything right now. So those that following this rule strictly have locked in 117 ticks, so $1,170. This is a good trading day. Now you want to be more aggressive. If we look at what's happening right here right now, we have this bullish pennant forming. Okay, these are the highs, these are the lows of the bullish pennant. Once we break out of this bullish pennant and we get a close up above it, we can be more aggressive with our trading stop and just go below the lows of these pivots here. And that would lock in approximately 204 ticks, so $2,000 profit there. So we've got to be patient with the range breakout. There's 4 different strategies with this indicator, and this is the straddle strategy, but we need a neutral bias when we get that opening range. So that doesn't happen all the time. A lot of the time we trade with the bias, but this time we had a neutral bias, so a fantastic opportunity to trade that straddle trade. Really, really good. Again, simple rules: bias depth heat map, more yellow than anything else. That's good. It's got to go within the first 3 candles after. See, we've just broken out of there now, just broken out. Okay, then we'd be more aggressive with our trailing stop here. Really, really strong here. This is the candles just turned green from grey, so there's more volume, more buyers in this. There's more. It's an accumulation candle, more buyers in this particular candle than the previous candle. This is very good. Get a close outside of this range that's formed. We can be very aggressive with that trailing stop at this point here. So then going back again, we decide on the trade management strategy depending on the color of the ribbon for the manager. If we're going long, and if it breaks out to the upside on the straddle, that's good. We know it's already green. We just use then this ribbon to stay in the trade, and again manage very, very simply. So this is very simple. One of the trading strategies of the Range Breakout Trading Indicator. The cradle to grave bundle that we have gives you a discount if you buy the Range Breakout and the manager together. Gives you quite a bit of discount to get both, and then just add the bias depth heat map for that confirmation, if you like. But a great trade. This is over $2,000 trade here. Really, really good. We've got $2,000 locked in on this trailing stop now, and this is the time to be patient, because this just could keep going. So candles closed, that's the confirmation. Put the trailing stop at this position. We've got $2,000 locked in now. If that comes against us, we take the $2,000 profit. If it doesn't and it continues to go, we just use the manager again. It's making new highs now. What the move on this now is something like 269 ticks. This is a big move, but again, very, very simple strategy. With that xBrat range breakout, we get lots of opportunities, 4 different strategies with the same indicator, whether it's reversals, straddle, continuation trades, or the range breakout as well. So hopefully that helps. Really great. Check out the links below. Simple strategy, but very, very powerful when we're trading oil range breakouts, gold, indexes, that sort of thing.